Financial crashes rarely arrive as surprises to those positioned to survive them. They arrive as confirmations. Long before prices fall, systems signal exhaustion. Participation broadens, leverage thickens, discipline thins. The end of a boom is not announced by panic, but by comfort. When risk feels ordinary, it is usually mispriced. In the late 1920s, American markets were widely described as modern, efficient, and permanently ascendant. This confidence was not irrational. Productivity had risen, new industries had emerged, credit had expanded access to ownership. What made the moment fragile was not optimism itself, but the structure supporting it. Growth had become dependent on leverage rather than income. Prices were no longer anchored to cash flow, but to expectation. One participant understood this shift earlier than most: Joseph Kennedy. His decision to exit the market before the collapse has often been reduced to anecdote or intuition. In reality, it reflected structural awareness. He did not predict a crash. He recognized that the system no longer compensated risk. At the center of his assessment was saturation. When speculation moves from professionals to the general public, information symmetry collapses. Early participants trade on analysis. Late participants trade on imitation. At that stage, prices incorporate belief rather than value. The market does not fail immediately. It continues upward, but its foundations change. Credit amplified this transformation. Buying on margin allowed participants to control assets far beyond their capital base. This accelerated price increases, but it also compressed time. Gains were borrowed from the future. Losses, when they arrived, would be immediate. Leverage does not create instability on its own. It concentrates it. The signals, Kennedy observed, were not numerical thresholds. They were behavioral. When conversations about stocks moved from offices to sidewalks, the informational advantage inverted. Professional capital began to exit, not because opportunity vanished, but because asymmetry did. The edge disappeared. Markets reward scarcity of insight. Once insight becomes common, returns diminish. Midway through this explanation, pause briefly. If you find value in understanding markets through structure rather than prediction, consider subscribing and leaving a short comment. Not to forecast outcomes, but to acknowledge that history often explains mechanics better than headlines. Kennedy's exit was comprehensive. He sold not selectively, but entirely. This matters. Partial withdrawal preserves exposure. Complete exit converts uncertainty into optionality. Cash is not neutral during a boom. It is unfashionable. That is precisely its function. It preserves flexibility when others exchange it for conviction. This strategy was not defensive in intent. It was preparatory. Financial cycles redistribute assets. Those who retain liquidity when prices fall gain access to what leverage forces others to abandon. Selling early is not about avoiding loss alone. It is about positioning for acquisition under stress. What followed validated the logic, but validation is not the cause. The cause was structural imbalance. Leverage had outpaced income. Participation had outpaced understanding. Prices had detached from resilience. The crash merely revealed what had already occurred. The deeper logic behind this exit becomes clearer when margin is examined not as a tool, but as a timing device. Borrowed money accelerates outcomes. It pulls future expectations into the present and demands that they be realized quickly. In such environments, markets no longer price durability. They price continuation. As long as prices rise, leverage appears benign. When prices stall, it becomes decisive. During the final phase of the boom, broker loans expanded faster than underlying income. This was not hidden. It was normalized. Credit was framed as access, not obligation. The system treated leverage as participation infrastructure. To own assets without borrowing began to feel inefficient. Cash appeared idle. Prudence looked outdated. This is where structural risk accumulates. Leverage narrows the range of acceptable outcomes. It reduces tolerance for delay. Even modest price reversals trigger forced selling. Not because fundamentals changed, but because collateral requirements demand action. Markets dominated by leverage do not correct gradually. They gap. The significance of Kennedy's decision lies less in what he sold and more in what he avoided. He exited before liquidity vanished. Liquidity is abundant until it is not. In leveraged systems, it disappears not because buyers lose interest, but because buyers lose capacity. When margin calls begin, selling is no longer optional, it is mechanical. This dynamic explains why the final ascent of a bubble often feels calm. Volatility compresses, confidence rises. The absence of stress is misread as stability. In reality, it reflects saturation. Everyone who can buy has already bought. The marginal buyer is exhausted. The system depends on uninterrupted price appreciation to remain solvent. Professional capital tends to recognize this earlier because its exposure is larger and its time horizon longer. It does not require peak prices to justify exit. It requires asymmetry. When downside accelerates faster than upside, rational withdrawal begins. This is not panic. It is arithmetic. The popular story of a casual remark revealing the top oversimplifies this process. What mattered was not who spoke, but what the speech represented. Diffusion of speculation into spaces without analytical filtering. When participation expands beyond valuation frameworks, markets lose their internal brakes. Prices no longer respond to information. They respond to momentum. The exit strategy, therefore, was not reactive. It was staged. Selling into strength preserves price. Waiting for confirmation invites slippage. This is why early exits are often criticized in real time. They look premature. They only appear correct in retrospect, because crashes are compressive events. Timing is not symmetrical. Once out of the market, optionality returns. Cash regains purpose. It becomes a claim on future distress. In leveraged collapses, assets do not merely fall in price. They are abandoned. Ownership transfers from those who must sell to those who can wait. This is how cycles redistribute wealth without legislative action. It is important to note what this strategy was not. It was not an attempt to control outcomes. It did not rely on predicting magnitude or duration. It relied on recognizing structural fragility. The system had become dependent on continued belief. That dependency is measurable through leverage, saturation, and behavioral uniformity. What followed the collapse was not chaos in the abstract, but reallocation. Markets did not disappear. They reset ownership. Assets moved from leveraged balance sheets to liquid ones. Institutions that survived did so not because they were correct about the future, but because they had preserved the capacity to wait. This is the final component of the strategy: endurance. Financial power does not arise from prediction. It arises from optionality under stress. When prices fall rapidly, choice disappears for those dependent on leverage. They must sell into declining markets to satisfy obligations created during expansion. Those without such obligations inherit the field. The aftermath of the crash revealed how unevenly time is distributed in financial systems. Some actors experience time as pressure. Others experience it as opportunity. Cash converts volatility into duration. It allows holders to defer decisions while others are forced to act immediately. This asymmetry, more than information, determines outcomes during systemic breaks. What appears from the outside as foresight is often the product of balance sheet structure. Selling early preserved not only capital, but agency. It allowed participation in recovery on favorable terms. Distressed assets are not valuable because they are cheap. They are valuable because they are available only to those who remain solvent when scarcity of liquidity replaces scarcity of belief. This is how fortunes are not merely protected, but compounded. Crises compress valuations across sectors indiscriminately. Strong and weak assets fall together when liquidation is broad. The differentiator is not quality, but patience. Those with liquidity acquire assets whose long-term productivity was never impaired, only mispriced under stress. It is tempting to extract tactical lessons from this sequence, to look for indicators, signals, or anecdotes that promise repetition. History resists this. Specific triggers change. Instruments evolve. Structures adapt. What remains consistent is the role of leverage, saturation, and time compression in late-cycle systems. Financial cycles do not end because optimism is wrong. They end because optimism becomes universal. At that point, risk has been fully distributed forward. There is no buffer left inside the system. Stability becomes brittle. Small disturbances propagate rapidly because flexibility has already been consumed. This is why exits feel uncomfortable when they are correct. They require separation from consensus. They appear inefficient relative to ongoing gains. They sacrifice immediate participation for future control. Systems reward this behavior only after stress has validated it. Before that moment, it looks unnecessary. The broader lesson is institutional rather than personal. Money is infrastructure. Its behavior reflects how risk is stored and released over time. When leverage concentrates exposure, finance accelerates outcomes. When liquidity evaporates, continuity favors those who preserved slack. Power follows endurance because endurance preserves choice. Systems evolve to absorb cost by redistributing it to those least able to avoid it. Finance enables continuity when direct consent fails, by enforcing outcomes mechanically rather than politically. None of this requires intent. It requires alignment. The so-called Kennedy strategy is therefore misnamed. It was not a secret method. It was a structural response to saturation and leverage. It succeeded not because it anticipated collapse, but because it recognized when the system no longer rewarded participation. History does not repeat as instruction. It repeats as constraint. Understanding that distinction matters more than memorizing signals. Markets will change their language. They will not change their mechanics. History explains the present without blaming it. History has the answers. I'll show you where to look. You can change this.